Today, we're going to unravel a topic that's crucial for anyone involved in international business or accounting. The heading you see, Foreign Currency Transactions Explained, sets the stage for a practical, story-driven exploration. Why does this matter? Because in our global economy, companies constantly buy and sell goods and services across borders, dealing with currencies that aren't their own. This creates unique challenges and opportunities. Throughout this lesson, we'll use real-world examples, like an American wine shop and a U.S. software company, to show how exchange rates can impact your bottom line. We'll break down the key principles, walk through step-by-step scenarios, and highlight the rules you need to know under U.S. GAAP. Let's start with the basics. A foreign currency transaction happens whenever you buy or sell goods or services using a currency that isn't your company's main or home currency. Imagine you're a U.S. company making a deal in euros or yen. Here's where things get tricky. Exchange rates, the value of one currency compared to another, are always changing. This means the amount you actually pay or receive can shift between the day you make the deal and the day money changes hands. As a result, companies can end up with unexpected gains or losses simply due to these fluctuations. Recognizing this risk is the first step toward mastering foreign currency accounting. Let's see how this plays out for an American wine shop ordering from France. On January 1st, you order 10,000 euro worth of wine. With the exchange rate at 1 euro equals 1 or 10 cents, you expect to pay $11,000. But by the time your shipment arrives on February 1st, the exchange rate has jumped to 1 equals $1.20. Now, paying for the same wine costs you $12,000. That's a $1,000 loss purely from currency movement. The wine's price didn't change at all. This example shows how exchange rates can directly impact your costs, even when the deal itself stays the same. It's a real challenge businesses face in international trade. Now let's flip the scenario and look at a U.S. software company selling to a German customer. On March 1st, you make a sale for 50,000 euros. At the time, each euro is worth 1 cent, so you record revenue of $57,500 in your books. But when the payment arrives on April 1st and the exchange rate drops to $1.10 per euro, those 50,000 euros are now worth only $55,000. Even though your customer paid every euro they owed, you end up with a $2,500 loss because of the weaker dollar. This highlights how timing and exchange rate changes can affect not just what you pay, but also what you earn. Here's the key takeaway when it comes to foreign currency transactions. They introduce a layer of risk that every business must manage, simply because exchange rates are always in motion. Imagine making a profit on your core business deal, only to see that gain wiped out, or even turned into a loss because the value of the currency changed between the transaction and settlement dates. The reverse can also happen. Sometimes, a company might lose money on the deal itself but gain from a favorable currency swing. This unpredictability is why companies often turn to hedging strategies, which are financial tools designed to lock in exchange rates or offset potential losses. Let's start with the foundation of foreign currency accounting under U.S. GAAP. The concept of your home currency, also called the functional currency. Every business operates with a primary currency for its day-to-day activities. Think of this as the financial language you use to measure performance. For most U.S. companies, the dollar is their functional currency. Why does this matter? Because U.S. GAAP requires that all foreign currency transactions, whether buying goods from overseas or selling to an international customer, must be translated into your home currency for reporting purposes. This rule ensures consistency in financial statements, making it possible to accurately compare results across periods and companies, regardless of where transactions take place. Now let's dive deeper into how U.S. GAAP handles foreign currency deals with what's called the two-transaction rule. Whenever you make a deal in another currency, like buying equipment from Germany, U.S. GAAP splits this process into two distinct steps. First, there's the business decision itself, buying the equipment. Second, there's the financial outcome, handling the impact of currency exchange rates. These are not lumped together. You record each separately because one reflects your operational choice and the other captures how exchange rates affect your finances. This separation helps clarify where value is created by business actions and where it's influenced by market forces, giving you a clearer picture of your company's true performance. Let's look at how you actually record a foreign currency transaction under US GAAP. The key rule here is simple. When you first record the purchase, say ordering machinery from Japan, you use the exchange rate on that specific transaction date. For example, if on June 1st you agree to buy machinery for tsuo 1,000, and the exchange rate that day is 100 equals $1, you would record the expense as $10,000. This amount becomes the locked-in cost of your machinery on your books. By using the rate on the transaction date, you capture the real cost at the moment of your business decision, ensuring accuracy in financial reporting. But what happens after the initial transaction if you haven't paid yet? US GAAP requires that at every reporting date, whether it's month-end, quarter-end, or year-end, you update any unpaid foreign currency amounts using the latest exchange rate, known as the closing rate. Let's continue our example. Suppose at June 30th, you still owe $1,000, but now the rate has changed to 90 equals $1. Your debt is now worth $11,111 instead of $10,000. That difference means you recognize a $111 currency loss on your income statement. This rule ensures your financial statements reflect current realities even before you settle up. Now let's see what happens when you finally pay off that invoice. The rule is straightforward. Use the exchange rate on the payment date to determine any final gain or loss. Continuing our example, imagine you pay on July 15th when the rate is 95 equals $1. The payment comes out to $10,526. Compared to the June 30 value of $11,011, this results in a $585 gain because the dollar strengthened. Adding everything up, you had a $1,111 loss at month end but recouped $585 by payment time. So your total net loss from these exchange rate changes is $526. This step-by-step approach shows exactly how exchange fluctuations hit your bottom line. So where do all these gains and losses from foreign currency go in your financial statements? Under US GAAP, they must appear directly on your income statement. They aren't tucked away elsewhere. Typically, you'll see them listed as other income or expense, or specifically labeled as foreign exchange gain or loss. This means any swings in exchange rates don't just affect your cash flow, they have an immediate impact on your reported profit for the period. It's a critical rule that keeps your financial results transparent and helps users of your statements understand exactly how global transactions affect your business. Let's talk about an important exception in foreign currency accounting: items that don't change value with exchange rates. The key rule is only monetary items like cash, receivables, or payables are updated for exchange rate changes. But non-monetary items, think equipment, inventory, or buildings, stay recorded at their original rate regardless of currency fluctuations. Here's a practical example. Imagine you buy land in Mexico for 1 million pesos when the exchange rate is 20 pesos to the dollar. That means the land is recorded at $50,000. Even if the peso's value changes later, your land remains on the books at $50,000. Why? Because you own the land itself, not just a claim to pesos. Let's bring everything together with the essential takeaways for foreign currency accounting. First, every transaction you make in a foreign currency must be converted into your company's functional currency, usually US dollars, using the exchange rate on the exact date the transaction occurs. This is crucial because it sets the baseline for all your accounting records. But the process doesn't stop there. If you have any unpaid amounts, such as receivables or payables that haven't been settled by the end of a reporting period, you need to update their value using the current exchange rate at each reporting date, whether that's month-end, quarter-end, or year-end. This ensures your financial statements reflect the most accurate, up-to-date information. Now here's where it gets especially important for investors and anyone analyzing your company's performance. All gains or losses that result from these currency updates must be shown on your income statement. This transparency makes it clear how much your results are affected by currency risk, helping investors understand the true impact of exchange rate movements on your business. By following these steps, you make your financial reporting both accurate and meaningful. There are 3 key dates you'll need to remember when handling foreign currency accounting. The first is the transaction date. That's when the business deal actually happens and sets your initial values. Second comes the reporting date, like month-end or year-end, which is when you revalue any unpaid amounts based on the current exchange rate. And finally, there's the settlement date. This is when cash really changes hands and you finalize both the revaluation and the business transaction. Keeping track of these dates is crucial because each one can affect how foreign currency gains or losses are recognized in your financial statements. Let's dive into a complete step-by-step example to see how these rules work in practice. Imagine you run a U.S. company and you sell products to a Canadian customer for $50,000. On July 1st, which is your transaction date, the exchange rate is $1 and equals 75 cents US dollars. To record this sale, you first convert the Canadian dollars to US dollars. $50,000 times 0.75 gives you $37,500. This is the amount you'll use in your accounting records. Next, you make the journal entry. Debit accounts receivable for $37,500 since you're expecting payment, and credit sales revenue for $37,500, reflecting the income from the sale. At this point, your books show sales revenue of $37,500, which represents your business performance, and accounts receivable of $37,500, which is the amount you expect to collect. This example highlights how the transaction date and exchange rate set the foundation for your accounting entries, ensuring your financial statements accurately reflect the value of your international sales at the time the deal is made. Now let's fast forward to July 31, the end of the month. Your Canadian customer hasn't paid yet, but now the exchange rate has changed. See $1 and equals 73 cents US dollars. If you convert $50,000 at this new rate, you get $36,500, a $1,000 drop from the original $37,500 receivable. To reflect this loss from currency movement, you record a debit to foreign exchange loss for $1,000 and a credit to accounts receivable for $1,000. On your books now, sales revenue stays at $37,500. Your business result doesn't change, but accounts receivable drops to $36,500, and you recognize a $1,000 FX loss due to exchange rate risk. Let's walk through what happens when a customer pays you in foreign currency, specifically Canadian dollars. On August 15th, your customer sends $50,000, and at that moment, the exchange rate is $1 and equals 74 cents US. Converting, you receive $37,000 in US dollars. Now compare this to July 31. Back then, your accounts receivable was recorded at $36,500. The difference means you gain $500 just from the change in the exchange rate. Here's how you record it. Debit cash for $37,000, credit accounts receivable for $36,500, and credit foreign exchange gain for $500. But overall, after factoring in earlier losses, you end up with a net loss of $500, showing how currency shifts can directly impact your bottom line. On the settlement date, August 15, the key accounting step is to revalue your accounts receivable using the current exchange rate. With $1 now worth 74 cents, your $50,000 is valued at $37,000. Compare this to the book value from July 31 of $36,500, and you see a $500 gain due to the currency movement. The journal entry? Debit accounts receivable and credit foreign exchange gain for $500. After revaluation, your updated accounts receivable stands at $37,000. Importantly, sales revenue remains at $37,500, reflecting your business performance, while the foreign exchange loss of $500 highlights the real currency risk impact. This two-step process helps clarify where gains and losses from fluctuating rates show up in your financials. Now let's finish the process. actually receiving the payment and closing out the account. On August 15th, when you get the customer's $50,000 payment, which converts to $37,000 US, you make one final journal entry. Debit cash for $37,000 to reflect money coming in, and credit accounts receivable for the same amount. This zeroes out your receivable balance, meaning it's fully settled and closed. This step is crucial because it not only completes the transaction cycle, but also demonstrates how each part of a foreign currency sale is tracked and reconciled in your accounting records. By following these steps methodically, you ensure both accuracy and compliance with US GAAP. Let's see how all of this appears on an income statement. Your sales revenue from the business transaction is $37,500, the amount you expected based on your sale. Subtracting the cost of goods sold of $20,000 gives a gross profit of $17,500, which shows your core operating performance. But there's more. Under other income and expenses sits a foreign exchange loss of $500. This captures the effect of currency fluctuations on your results. After considering all these elements, your net income comes to $17,000. This layout makes it clear how foreign currency movements aren't just background noise, they have a direct line to your reported profits. Let's break down one of the most fundamental skills in foreign currency accounting, converting foreign currency transactions into your home currency. The process starts with a simple but essential formula. Amount in home currency equals amount in foreign currency divided by the exchange rate. For example, if you're dealing with Canadian dollars and the exchange rate is quoted as C$1 equals 74 cents, you'd take the amount in Canadian dollars and divide it by 0.74 to get the equivalent in US dollars. However, it's important to note that sometimes the exchange rate is quoted the other way around, so you might need to multiply instead. Always check how the rate is presented before you start your calculation. This formula is the backbone of all foreign currency accounting, whether you're recording sales, purchases, or settling accounts. By mastering this basic conversion, you'll be able to accurately translate foreign transactions into your company's financial records, ensuring compliance with US GAAP and providing a clear picture of your business's true financial performance, regardless of currency fluctuations. Here's a handy memory trick for quickly working out whether to multiply or divide when converting foreign into home currencies. If the foreign currency is on the left side of the rate, for example, £1 equals $1.25, just multiply by that number to get home currency. If your home currency is on the left, like $1 equals 150, then divide by that number instead. Check out these examples. £10,000 times 1.25 gives you $12,500, but $300,000 divided by 150 results in $2,000. Or you can remember this way: foreign currency first multiple FM and home currency first divide HD.